another of our webinar for today, and the topic that we have today is related to business tax deduction. Okay, first of all, to start, I just want to mention about our non-responsibility disclaimer. The information that you are seeing today or listening today is not of legal in nature. So if you are looking or seeking legal advice, please consult a lawyer. So like I mentioned today, our topic is about business deduction. But before we can start talking about that, let's try to get some understanding of some of that concept. There is three main concepts that we want you to make sure that you understand. One of them is exemptions. Exemption is a reduction of what is counted as an income. By income, we mean taxable income. For example, many of you receive PPP during COVID time, and those PPP, if they were forgiven, will be considered as a tax-exempt income, which means that you don't have to pay taxes on that income because you receive it, so it's exempted. So you don't need to pay it for that income. So that is called exemption. The other one is a deduction. Deduction is an expense that you either incurred or you pay that reduce the amount of income that you are subject to taxes. And the last one is credit. Credit is a dollar for dollar reduction of your tax bill. Many people get confused with the concept of deduction and the concept of credit. So the deduction is a reduction of your taxable income, right? So credit is a dollar per dollar of your tax liability. Let me give you an example. Let's say that you buy an auto, a truck. A truck is a deduction. So which means that if you buy it, for example, for $30,000 and you have a taxable income of $100,000, it will reduce your taxable income for the amount that you pay for that truck. And then the amount of taxes that you are saving, it just depends on your tax bracket, right? So if your tax bracket is 21%, then you are only saving 21% of that deduction. But the credit, which usually is way better than the deduction, it will reduce the amount that you pay on your taxes dollar per dollar. Some common tax credits are the tips credits and also like energy credits or research credits and deductions. Some of those deductions are, those that you normally will know. For example, if we are dealing with utilities, rent, cost of goods sold, so those are deductions. A lot of people actually, if you could, you will take a credit instead of a deduction because it's way more beneficial than a deduction. So now let's talk about some of the guidelines around deduction. So first of all, business expenses are the cost of carrying on a trade or business, right? So you have to have, in order to deduct expense or a deduction, the expense must be ordinary and necessary, which means that it has to be for business. You can only deduct business expenses. So we need to keep in mind that there are three different category of deduction of business expenses. One of them is called your ordinary and business deduction, which is normally your expenses related to cost of goods sold or utilities, rent. The other one is called capital expenses. This kind of expenditure, sometimes, and it just depends on the law, normally it has to be capitalized and then depreciated. And sometimes the IRS allow you to take either a bonus depreciation or a section 179. So for the year 2020, for example, the bonus depreciation was 100%. So if you bought an asset that you are required to be capitalized, you can deduct it 100%. And then the other one is personal expenses. Personal expenses are those expenses that you use it for personal use and that it cannot be deducted. So we normally don't recommend you to commingle or use your business account for your personal expenses. You should have another account for your personal expenses, and then the business account is only for business. So personal expenses are not deductible. Only business expenses are deductible for the business. So in order to know when you can deduct expenses, we need to understand a concept about method of accounting. So there is two methods of accounting. One is the cash method, which generally means that you can deduct expenses when you pay. Or you recognize revenue, either you receive it or you constructively receive it. That means that, for example, if I give you a check on December 20th and I pay you, either, if you didn't deposit it to the bank account, that will still be considered as you revenue because you receive it. The other method of accounting is accrual method, which basically you recognize income or expenses after all events have occurred. For example, you earned that income even though you haven't received the payment, then you will have to recognize that as an income even though you haven't received the payment because you already earned it. The IRS sometimes requires you to use the accrual method of accounting, and sometimes you don't have the choice to do it under the cash method. And for most of the small businesses, cash method is the most is allowed, and also is the most convenient way to recognize your income and expenses because it's the easiest way to do it. In terms of deduction, we mentioned that there is a concept called cost of goods sold. Normally this is used when you have inventory or that you manufacture a product or you buy a product for resale, right? For example, let's say that you are a home flipper, okay? You buy houses, you fix it up, and then you resell it. So most of those houses will be considered under inventory at the time of purchase, and then when you sell it, then all the costs incurred for that house then will be recognized as a cost of goods sold. Keep in mind that when you are dealing with cost of goods sold, you have to do a year-end inventory count if you are a big company, so you know what you have left as an inventory. Because sometimes you might be in a situation that some of your inventory is obsolete or that you don't have it any longer, and that shouldn't be part of your inventory. Startup costs. A lot of people, when they start the business, they incur significant amount of money starting up the business. So the IRS allow you to take a deduction of $5,000 if you invested or you incur less than $50,000 in your startup cost. If you incur more than that, then you will have to make some adjustment to the amount of expense that you are allowed to deduct for that year. Some of the startup costs that you have is advertisements, salary and wages, travel expenses. And then the rest of the amount that you are not allowed to deduct for that year, then you have to amortize it for for a period of years, so you can take it every year that you are in business. One of the most common deduction is auto expenses, and a lot of people get confused about what can be deducted or how that can be deducted in your tax return. So there are two methods of deducting or calculating the auto expenses. One of them is called the mileage method or the standard method. The other one is called the actual expenses. So what are the difference between these two? The standard method, the government gives you a rate. So for example, for 2022, as you can see here, they break it down into two periods. For 2023, they only have one rate, but for 2022, they have two. And the government sometimes adjusts it depending on the, the cost of gas. So if it go higher, then the government will make an adjustment. If it go down, then the government will make an adjustment. So basically what the government is saying that they are paying you a flat amount per mile. So when that happens, then you cannot take any other kind of deduction, because on that rate that the government is giving you, pretty much they already did a calculation and they come up with the amount that you are allowed to deduct per mile. The actual expenses, pretty much just like what it's saying, is that you can deduct any cost or expenditure incurred for that auto. So if you pay for gas, if you pay for repairs, if you pay for insurance, then you will just deduct the amount that you pay for those expenditure. But if you are using a standard mileage, pretty much it's just the mileage rate that you can take. So here we can see a chart. So if the auto is for business, let's assume it is for business only, then you will be entitled to deduct the cost of ownership and operation of that auto. Normally it will be the actual expenses, but if it is a mix, for example, let's say you have an employee and they drive around town using their own car. So in that case, then you can use the mileage as a reimbursement. So you can decide what you want to do. Between mileage and the actual expenses, just keep in mind that there are certain limitations or regulation about that. For 2023, the government is paying you 65.5 cents per mile. And this one you can use either for the auto that you own or to reimburse your employee. One of the limitations about the standard rate is that you cannot use it if you have more than 5 auto. They consider you as a fleet company or vehicle, so therefore they don't allow you to use the mileage. Otherwise you will have to use the actual expenditure for that. And sometimes one of the confusion is that, if I want to do mileage, can I still deduct the cost of the purchase of that auto truck? And the answer is not. Like I mentioned before, if you are taking a standard mileage rate and doing that kind of mileage calculation, then you are not allowed to take any other kind of expenditure. So one of the requirements for you to keep what kind of record, when you are using the mileage, is that you need to keep a log. So basically you have to keep a record where did you go and the mileage and the purpose of that mileage. For actual expenditure, then you are required to keep your actual receipts, like invoices or some kind of proof that you have for that expenditure. So that is one of the biggest difference between these two. One is that it pay you per mileage rate, and the other pay you for actual expenditure. And then the record that you need to keep is, one, you need to keep the log if you are going with a mileage, or you keep the actual invoices that you have. The other type of deduction that we have, and this one is a famous one, is the business meal. So in the past, at least in 2022, the government allowed you to deduct 100% of the food and beverage, the meal and beverage, if you bought it from a restaurant. But that ended for 2023, so that is not allowed anymore. Keep in mind that when we are talking about business meal, it has to be for a business purpose, your meal, to be able to deduct it. So in terms of employee, what the IRS allow you to do is that you can take a 50% deduction of the meals that you furnish to your employee. 100% deduction if they travel out of town. For example, if they go for some kind of training, or if they need to do some kind of job out of town and they need to stay in hotel, and then they will allow you to deduct that meals 100%. Deduction of home office. So there is two ways to do this kind of calculation. So first of all, let's talk about the home office deduction. What is included in that home office deduction? Pretty much, as you can see here, there is a mortgage interest, the insurance, utility, repair and maintenance. Those are deductions that you can include as part of your home office. The only difference is that because it's a home office, you cannot take 100% deduction, right? Because it's not like you are renting a place for your business. This one is just saying that it is your home and you have a section of your home that you use for business, and therefore you want to deduct certain costs that you incur for your home. So the government allow you to take the simplified option method that normally we see it on the Schedule C of your personal tax return, and they pay you per square feet that you use for the house, for your home, for the business, up to a maximum 300 square feet or 1,500. So if you use more than that, the simplified method will be capped at $1,500 deduction. You cannot take more than that. However, if you think it's more convenient for you to take the other method, then you will take a percentage of the home office use and then calculate the deduction that you have. When you are using the simplified method, you don't need to keep any kind of proof. For example, utilities, mortgage, or anything like that. It's just a method based on your square footage of the business use of your house. But if you go with the other method, you need to keep a record of how much you pay for utilities, how much you pay for your mortgages, and then you need to calculate also, if you are making a repair or maintenance, is that through the whole house or is just your home office that you are making that in order to take that deduction. So it involves more calculation and also involves more record keeping. So that means that for that one, you need to keep proof of the expenditure and the calculation that you have. Travel expenses. If you are mixing your personal and business travel expenses, keep in mind that you can only deduct that portion that is related to the business. So if you, for example, went to out of town and you stay in hotel for 3 days, but out of those 3 days, only 2 days were for business, then you are only allowed to take 2 days as a business deduction and not the third day, because that day is for your personal use. Okay, with the same kind of concept, you can take the cost that it was incurred for that travel, which is if you drove, then it will be auto expenses, or if you have to take an airplane, then it will be your air ticket. So it just depends what kind of transportation you use, so that will be incurred. And remember that meals is part of your travel, and if you incur, and that is 100% deductible. The IRS also allow you to take a per diem instead of actual expenditure if you would like to do so. Depreciation is a concept that is related or tied to the capital expenditure that we mentioned earlier today. So it's the concept to say that when you buy a capital asset, it's an expenditure, but sometimes the government doesn't allow you to take a deduction right away. So you have to depreciate it, and it just depends on the class of asset that you bought. For example, if we are talking about equipment normally is 5 years, furniture and fixture is normally 7 years, residential rental property is 27.5 years, and commercial property is normally 39 years. So those are the years for each class of asset that the government allow you to take, and it just depends. It just depends on the asset, and it depends on the regulation that you have. Like I mentioned before, for 2022, the government allowed you to take 100% bonus depreciation, which is similar to the section 179. Each of them has their own limitation, but this one allows you to take a expenditure in a year or have to be carried forward into different years. So it just depends of the amount that you were able to take for that particular year that you put the asset in use. So keep in mind, when we are dealing with depreciation, the asset that you purchase has to be placed in use in order for you to capitalize it and take it as a depreciation. So if you bought equipment, let's say on December 31st, or you bought it, actually, let me take it back. Let's say you bought it on December 1st, but you didn't use it or you didn't put it in use, so the asset is not active, then you cannot depreciate that asset until the asset is ready to be used. Bad debt is a different concept or expenditure or deduction. Bad debt, really, you don't spend it, right? But it's a deduction. The concept of bad debt is related or tied to revenue, basically saying that for accrual, okay, cash basis of accounting doesn't have bad debt, but only the accrual method has the bad debt. The bad debt is saying that you recognize revenue in a prior year and somehow people didn't pay you or the company didn't pay you, but you already recognize that revenue. So you are saying, you know what, I won't be able to collect on this amount, so this one is a bad debt. It's a deduction on your taxes because you are not able to collect that. For that, you know, there are certain regulations which normally it has to be either 100% worthless or partially worthless. So it's not like you just come up with a concept today and you say all of these are bad debt. There are certain requirements for that the IRS require you to give you some kind of guidance to tell you that, you know, what are considered to be a bad debt and which one is not. But normally, like I say, it's tied to accrual method of accounting, and you cannot use it if you are cash, because cash, you never recognize the revenue, therefore you cannot recognize a bad debt as a deduction or take it as a deduction. So what are some of the other type of business expenses? So retirement, if you contribute for a retirement plans, for example, you do employer match to a 401k, those are expenditure, those are deductions that you can take: rent, interest, taxes, insurance. So there are so many more deductions in a business that you can take that we probably didn't mention today. So if you think like you have any kind of other expenditure or deduction that you think you qualify but we didn't mention, please talk to your tax preparer and let them know, because sometimes you might have some kind of expense that maybe is unique for your business and that you use it for business purpose only, but that sometimes you doubt it or nobody mentioned if those are deduction allowed by the IRS or you of the estate, you know, depending on the estate filing. So if you are in that kind of situation, please consult with your tax preparer and they will be able to inform you if the expenditure that you have is a deduction or is not a deduction, or maybe it's a capital expense, or maybe it's not deductible. It's a non-deductible expenditure. So keep that in mind. So the best recommendation that we can give you is that anytime that you have doubt about an expense that you have, if that can be deductible or not, please consult your tax preparer. And with that said, we finalize today's webinar. If you have any question, please consult your tax preparer, or if you would like, you can give us a call at the phone number that you see here on the screen. Is 515-288-3188. If you would like, you can send us an email at catering@communitycpa.com. Visit us at www.communitycpa.com. And with that said, we